This is a short introduction to Chapter 4, Completing the Accounting Cycle. I want to call your attention to 4 learning objectives to focus in on. First of all, your chapter defines the accounting cycle. There's 10 different steps in it, but it breaks down into 3 categories: daily, monthly, and year-end. And completing the accounting cycle is concerned with issuing financial reports, income statement, equity statement, balance sheet, monthly or quarter end, and at year end. The accounting cycle in your book, again, has 10 different cycles, but they break down into a daily cycle, getting information into the books, analyzing transactions daily, journal entries, posting them to ledger. So you're getting data into the books in the first cycle. The second cycle related to month end. The 10-column worksheet comes into play here, and this cycle essentially says how do we pull off financial statements. Income statement first, equity statement second, balance sheet last. And then the third part of the accounting cycle, year-end only. We want to close out temporary accounts, the red accounts, revenue, expense, and the drawing account. In closing entries, you need to understand which accounts are temporary, only serve the purpose for the current year, and are set to 0. We'll come back to that. Let's look at the second objective here, the 10-column worksheet. Here's an illustration in your chapter that starts with a unadjusted trial balance. What's it adjusted for? The adjusting journal entries of Chapter 3. Where we freshen up the financial condition for accruals and deferrals. Accruals are establishing financial positions before cash flows, and deferrals or prepaid adjustment journal entries are looking at previous transactions where cash moved either in or out, but the final ultimate destiny of those transactions were deferred until they're adjusted at month end. And all adjustment entries result in either an increase in the revenue account or an increase in an expense account, offsetting assets and liabilities. So the columns 5 and 6 are the adjusted trial balance, simply the beginning balances adjusted for journal entries, resultant adjusted trial balance. And the key here is that from this point, we develop our financial statements. Income statement first, which is generally the easiest because it's just the revenue and expense accounts pulled off. And then the balance sheet is pulled off, all the remaining accounts. The key to remember here is in the balance sheet accounts, embedded in here is the equity statement. It's not shown explicitly, but it starts with the beginning balance of owner capital, deducts any drawings for the period, and adds in any net income. That will develop the equity statement. It's not explicit on here, but it's embedded. Going back to closing entries, the third cycle of the accounting cycle, done at year-end only. We're just concerned with closing out the temporary accounts. Again, the temporary accounts collect their data during the year, mainly for the income statement, the revenue accounts and the expense accounts, and close them into the permanent account, the owner capital account, and also the owner drawing account. Measures drawings for the current fiscal year. That's closed into the owner capital account, which is a permanent account. So the closing process is all about getting the revenue and expense accounts and the drawing account into a permanent account at year end. Permanent just means that there's going to be a balance at year end that's carried over to the next year. The balances in the revenue accounts, these are zeroed out by a journal entry because they just measure revenues for the current year. So whatever credits are accumulated in there are zeroed out by debiting the revenue account and pushing the credit into an income summary account in itself, which is a temporary account. So we push the credits of revenue into income summary, zeroing out the revenue accounts. Likewise, the expense accounts having debit balances, those are closed out with a credit, and the debit is moved to income expense summary. This is zeroed out. Debits are moved into here. Individually, if there's 15 expense accounts, there's 15 entries here, only one entry into income summary. That difference gives you the net income for the year. That then is closed out. If it's net income, it's a credit balance. It's closed out with a debit, pushed into owner capital at year end. And likewise, the owner drawing account only measures the drawings for the current year. Debit balances, which counter the normal credit balance of the owner equity category, that's closed out with a credit, pushing the debit into owner capital. The owner capital activity then, in effect, is the activity needed for the equity statement. Again, so we're just closing out the red accounts, revenue, expense, and drawing account. They're temporary. They only measure activity for the current fiscal year. These three accounts are all set. Maybe only one or two revenue accounts, many expense accounts, one drawing account. They're all set to zero to do activity, measure activity for the next fiscal year. The last learning objective I want to call to your attention is the classified balance sheet. Previously, when balance sheets were shown, they simply had several accounts, asset accounts totaling down to final assets, total assets for the year, several liability accounts coming down to one liability total, then the owner equity section. The classified balance sheet introduces meaningful subtotals. So not just a total asset number, but subtotals, such as cash, accounts receivable, office supplies, prepaid rent, to a current asset balance. This is key. We want a subtotal on current assets. This is the category of assets that companies conduct their day-to-day business. What are current assets? Cash or items turning into cash or used up within 12 months. Likewise, another important subtotal in the classified balance sheet is not just total liabilities, but current liabilities. Current liabilities are items that will be paid within the next 12 months. So the key in the classified and the current liability subtotal. There are other subtotals up here. Property, plant, and equipment is a separate category. Long-term assets, we'll learn about these in a subsequent chapter. Not intended for resale, used in the operations to sell or make product. The other category down below here is beyond current liabilities, there's other liabilities in long-term, that is those not payable in the next 12 months. So this relationship of current assets to current liabilities is the key one to be emphasized in the classified balance sheet. And there's a couple ways of looking at this. First of all, is a ratio. What's current assets, current liabilities? This ratio here is $16,000 of current assets, $2,000 current liabilities. That's an unusual ratio. That's about an 8-to-1 ratio. That's unusual. More common, several decades ago, this ratio would generally be about 2-to-1. $2 of current assets for every $1 of current liabilities. Today, it's more common to see a 1-to-1 ratio. $1 current assets for every $1 current liabilities. Companies are running leaner today which means that if there's a downturn in the economy, there's less current assets to pay current liabilities. Okay, current liabilities, these liabilities paid maturing within the next 12 months are paid out of cash that's generated from current assets to pay these off. So, main takeaway from the classified balance sheet is that relationship of current assets to current liabilities, subtotals to allow a reader of financial statements to see how solvent the company is, how much near cash do they have to pay their near-term current liabilities in the next 12 months. So paying attention to these 4 learning objectives will help you focus in on key topics in Chapter 4, completing the accounting cycle, issuing financial statements monthly. The 10-column worksheet allows a user to develop these financial statements, closing entries only at year end, and the classified balance sheet comes in terms of an analysis after the fact, presenting information in a more meaningful format for readers of financial statements. Key subtotals.